Hello everyone, good afternoon and welcome to today's Professional Advisor Working Lunch, brought to you with our partner, Baillie Gifford. I'm Katrina Lloyd, I'm Editor-in-Chief for Professional Advisor, and I'm going to be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. I should inform you that this session is being recorded and we'll send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So now let's get on with the session. Just going to move my slides along so we can see that there. Is greed good and sin back? 10 years on from the launch of the UN's Sustainable Development Goals, the investment backdrop looks very different to 2015. How should we think about investing for sustainable and inclusive growth in a world characterised by a higher cost of capital, fragmented geopolitics, and rising ESG scepticism? How can you invest to make exceptional returns and help to solve global challenges? I'm delighted to be joined today by Rosie Rankin. She's Investment Specialist Director with Baillie Gifford's Positive Change Fund, and she's going to explore why their conviction is stronger than ever that the world's most profitable companies will reflect the long-term needs of our time. Positive Change is a global equity fund with two equally important objectives: to generate attractive investment returns and to contribute towards a more sustainable and inclusive world. Do feel free to put any and all of your questions to Rosie using the chat function, which you'll find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. Just before I hand over to Rosie and we start the session, let me quickly run you through our learning objectives for today, which are to explore the changing backdrop for sustainable and impact funds, to understand how solving global challenges are already providing some of the great structural growth opportunities of the coming decade, and to consider how technology has the potential to supercharge positive progress. So that's the CPD covered. I'm pleased to introduce Rosie. Hello, Rosie. Thanks very much for joining us this afternoon.
No, thank you very much for having me.
And we're going to structure the session a little bit differently today. I've got a few sort of broader questions for you, Rosie, and then you're going to that's going to allow us to tap in a little bit to your thinking and some of the slides and information that you want to share with us today. So let's start off. It's been a decade since you started working on Positive Change. A lot's happened since then. Lots changed in the world, and in many ways, it feels a less favourable environment now for sustainable funds. Well, what are your thoughts looking back on that period?
Yeah, I think that is a great place to start, because if we cast our mind back to 2015, what were you doing then? Let me just get onto the slide. Here we go. In the grand scheme of things, a decade is not a particularly long period of time, but in many ways, 2015 seems like a lifetime ago. Barack Obama was halfway through his second term in the White House. The UN had just launched the 17 Sustainable Development Goals with that explicit aim of leaving no one behind. COP21 had resulted in the Paris Agreement, which had the ambition to limit global warming to 1.5 degrees. And from an economic perspective, it was an era of low interest rates and inflation. Bank of England base rate was 0.5%, and the headlines talked of UK inflation turning negative. And then, incredibly, from a stock market perspective, Apple was the world's most valuable company, and speculation was rife at that point about whether any company could reach the heady heights of $1 trillion market cap. So, kind of looking back at, a lot has changed, and against that sort of favourable backdrop in 2015, we saw a huge number of sustainable equity funds launching. But then around about 2021, 2022, things changed. As we can see from recent years, the number of new sustainable fund launches has slowed to a trickle. And what this chart doesn't show is the other side of the coin, the number of sustainable fund closures, either funds that have closed altogether or have pivoted away from their sustainable objectives. And looking at the backdrop and perhaps what has kind of precipitated that, the backdrop in 2025 does feel very different to 2015. From that macroeconomic perspective, the post-pandemic period, of course, saw that very steep rise in interest rates and inflation. Trump's second presidency is seeing the rise of tariffs and global trade tensions. The world feels much more fragile from a geopolitical perspective. And of course, we have rhetoric such as drill, baby, drill. So that makes us question, is greed good and sin back? Now, despite the headlines, we don't think so. We believe that a range of high quality structural growth opportunities await that solve the world's biggest challenges. But looking forward to sharing more.
Thanks for kicking us off there, Rosie. Yeah, and that leads us into us. So what gives you confidence that your thesis that growth and positive impact go hand in hand still holds?
Yeah, and really that's the crux of our philosophy and what gives us confidence in the future. But when we look to the future, we often look to the past, because time and time again, history has shown us that technological surges catalyze change. Now, the charts I'm going to show you on the next couple of slides are from the work of the 2025 Nobel laureates in economic sciences. Now, this first chart shows UK GDP per person over a 500-year period from 1300 out to 1800. And over those 500 years, there were some really significant inventions. So in 1300, windmills sparked a revolution because, of course, they turned the kind of invisible force of wind into energy, which freed people from a degree of physical labour and laid the groundwork for modern power. Or you have the printing press, making knowledge reproducible and breaking the monopolies of information, which was enabling the spread of literacy and science and new ideas. And then at the end of that 500 period, Newton's third law of motion, which revealed a sort of deeper truth that every action meets a reaction. And this principle explained how the physical world moved. Now, these inventions changed how people worked and thought, but not how most people lived. For centuries, as you can see, incomes remained largely unchanged. And this is because those tools for progress existed, but the mechanisms to sustain that progress did not. Innovation arrived in bursts, but progress stalled in between. Ideas were born, but they didn't build on each other. Now, all that changed come around about 1830 with the introduction of the steam engine. Now, of course, that enabled insights into atmospheric pressure and vacuums. We had advances in iron and steel, and power no longer depended on nature's pace. So energy could be generated, stored, and moved, carrying people, goods, and ideas faster than ever before. So, in a nutshell, living standards rise when societies turn discovery into broad application. But of course, that process doesn't stop there. We need a constant flow of new ideas, people that challenge and improve these ideas, and then new and better ideas as a result of these improvements. So essentially, we need these surges of change because these surges need investment and create opportunity. And that's what really gives us confidence looking ahead, because we know that these changes can create prosperity. They can also generate significant investment opportunity. And looking to the years ahead, we see real investment opportunity in solving some of the big structural challenges facing the world. I feel I can't present today without talking about the kind of innovation that's on everybody's minds just now, which is, of course, AI and the changes that that will bring. And for this, I really kind of wanted to think about the companies within the positive change portfolio. So we have exposure to AI within the portfolio in different ways. Firstly, through those enablers on the left-hand side of the slide that you're looking at. So these are companies that are enabling AI to be accessible and affordable throughout many different applications. So, for example, there's ASML, which is the Dutch company making lithography machines that enables the printing of wafers. It has a monopoly on the most advanced sort of lithography machines, which are EUV machines. Or TSMC, a foundry, which is the world's largest manufacturer of semiconductors. Now, both of those, ASML and TSMC, have been in the positive change portfolio since our inception back in 2017. They are critical enablers of innovation, and they've also been amongst the top 5 contributors to performance. We've recently added ARM to the portfolio. It produces instruction set architecture, so basically an IP that defines how the CPU, so that central processing unit within hardware, is controlled by the software. The reason that we're really excited about ARM is because it enables much greater power efficiency of the semiconductors, so can really save the amount of energy used within those semiconductor chips. But it's not just about the infrastructure. The same way that railways weren't just about the tracks and the steel and the engines travelling on them. It's about what AI can enable. And this is when it gets really interesting from a portfolio perspective, because many of the companies within the positive change portfolio are using AI to solve big problems. So I've chosen 3 here to talk about today. So we could think about a company like Shopify, which is the Canadian platform that enables merchants of all shapes and sizes to transact online, to build websites, attract customers, and allow the customers to buy their products. And Shopify is at the vanguard of using AI to enhance that merchant and shopper experience. They're doing lots of interesting work just now in terms of agentic AI. Or Duolingo, the learning application, which is using AI in 2 different ways. One, to enhance the user experience. So if you're a user of Duolingo, you've maybe had the pleasure of conversing with one of the characters in your chosen language that you're learning. Again, that's facilitated by AI. But Duolingo are also using it to speed up the pace of their own development. When we look at Duolingo's first 12 years in existence, it managed to launch about 100 languages during that first 12 years of existence. In the last year alone, it's launched 148. So the pace of development that AI is enabling is startling. And then finally, John Deere, completely different type of company, will be familiar to many of you as that manufacturer of agricultural equipment. It's using AI within its precision agriculture technologies, so that technology that allows farmers to be very precise in how they apply chemicals and pesticides. It can reduce chemical use by about 70%, which is really attractive for farmers. It reduces their input costs, but also very beneficial from an environmental perspective because it significantly reduces chemical runoff. This is hopefully just giving a flavour of the types of innovation that we're seeing within the portfolio that we think has the ability to generate both attractive investment returns, but also help contribute to solving some really big problems within society. And talking of problems, it would be remiss of me to mention AI at all without mentioning that we are very conscious of the negative impacts of AI too, both from an environmental perspective, so particularly the amount of energy and water that data centres can consume, but also looking out more longer term about potential social consequences of AI, about disruption to jobs, for example. Certainly on that immediate environmental negative consequence, again, we can address that through portfolio companies. So we have Ecolab within the portfolio, which is a company that develops different solutions within hospitals and restaurants for managing water and maintaining hygiene. But specifically for data centers, they have a product that allows the recycling of water within data centers and helps data centers be much more energy efficient. I'll pause there because that's a lot of talking and a lot to digest.
Yeah, I was going to ask you, just following up on that, around that question around AI and as you said, the sustainable and impact considerations there. How do you look at that in terms of assessing whether to include a company in the portfolio? What sort of progress would you like to see from them on those particular issues when you sort of engage with them?
Yeah, I think it's that thinking about, is this company using AI responsibly? And there's it's a complex topic and it's evolving quickly. But aspects that we're looking at with companies is like, what's their responsible AI policy? Do they even have one in the first place? And if they do, what are the contents of that policy? How are they thinking about issues such as data privacy and cybersecurity? How are they thinking about some of the softer factors around kind of cultural adoption and thinking about how stakeholders are affected by AI? And then also thinking about how they're managing any environmental consequences of their use of AI. So it's kind of a multi-layered approach. And I have to say, our framework is evolving as we learn more. AI is such a kind of broad catch-all term, and the technologies are evolving so rapidly. But what we can do as investors is ensure that we have frameworks and are asking our companies that kind of consistent set of questions.
Yeah. Let's move on to talk a bit about the energy transition. And you mentioned earlier the backlash against renewable energy and the drill baby drill mantra. So how are you thinking about the energy transition going forwards?
Yeah, we're thinking a lot about that, and perhaps I can literally shine a light on that. Going back to 1830, and that was at the start of that second chart I showed about the kind of the time of the railways. It took about 6 hours of work to generate an hour of bright light. Today, it's about a tenth of a second. And of course, that whole incredible progress has been supported by the transformation that we're seeing in energy. And for the first time, we're starting to see signs that global growth is decoupling from fossil fuels. So carbon emissions are still rising, but much more slowly than GDP, thanks to renewables and technologies that make energy use kind of smarter and cleaner. And it's that combination of clean generation and efficient consumption that we think could reshape the entire foundations of the global economy. Because globally, no matter whether you're pro or anti-fossil fuel, we need abundant and affordable energy. And as renewable energy comes down the cost curve, to harness all of the benefits of renewable energy, we need to electrify at pace. It's estimated that we need to build more electric infrastructure in the next 30 years than we did in the whole of the previous 140. So what does that mean in terms of investment opportunity? And there are many ways that we as investors can think about electrification. whether that is investing in renewable power generation, or importantly, the infrastructure that supports it. So, for example, we've been thinking about how the generation of renewable power, so whether that's offshore wind farms or solar farms, carry power from the source of generation into the electric grid. So that's cables. They're very specialist cables produced by companies such as Prysmian, the Italian manufacturer of cables. Or thinking about digital infrastructure. So sensors, software and automation that you can use to help make your electric grid more efficient that are provided by companies such as Schneider. Or, of course, one of the big challenges of renewable energy is that problem of intermittency, that you don't produce energy at a consistent rate. At times you'll produce more energy, at other times less. And of course, your surges of energy production don't necessarily meet your surges of consumption. So you need battery storage, which is where companies like Cattles comes in terms of providing the batteries that help stabilize grids, but also the batteries that help power things such as electric transportation. So I think, again, when we think about the energy transition, the raft of negative headlines just now can detract from the fact that there is tremendous progress being made, and there is a huge opportunity when we look out over the coming decades, because the challenge of producing the enough power that the world needs hasn't gone anywhere.
Thanks for sharing that, Rosie. And we'll talk a little bit more about your reflections of this year a little bit later in the conversation. Maybe just to finish this part of the session, I know we wanted to talk a little bit about social impact, and that is an area that's attracted a lot more interest in recent years. I suppose if you're looking back at 2015, it was a lot more about the environmental side, but this is a really big area for investors. So maybe you could give us your thoughts around that side and how that fits in with Paul.
Yes, yeah. I'm really happy to do that, because you said it's a really important aspect to think about in terms of the huge amount of social challenges that we face globally. And I wanted to talk today, there was lots of different aspects I could have chosen, but in terms of thinking about financial inclusion. And if we just pause for a moment and imagine waking up tomorrow with no credit card, no banking app, no debit card, no safe way to send money or store your savings. And that is the reality still for billions in the world. Now, in 2011, the areas of the globe shaded in purple there are all regions of the globe where over 30% of adults in the region had no access to banking services. So in total, there was about 2.5 billion adults who fell into that category. Now, since then, a huge amount of progress has been made. You'll see this chart from 2024, and the number of shaded regions has declined. There are now 1.4 billion people without access to banking services. Now, that's still a huge number. It's about a quarter of the world's adult population that remain outside the formal banking system. But the progress does show what is possible when mobile technology and digital technology meets innovation. The World Bank has noted that bringing these people into the financial system, the formal financial system, has brought hundreds of millions into kind of economic participation. It's cut costs and reduced friction. And I think, kind of drawing parallels back to that work that I showed you from the Nobel laureates, it's this sort of continual replacement of old systems by better systems that can create positive impact and financial opportunity. Drilling down to a specific example of a company which helped to enable this improvement in financial inclusion, we can look at Nu, which is a Brazilian digital bank. Much of Latin America has had traditional banks that have essentially ignored lower income customers. They have been relatively inaccessible, certainly expensive to deal with. And Nubank was set up specifically with that aim to disrupt the banking incumbents. It built a mobile-first digital platform. It lets users open a free account, amazingly, instantly. It enables them to access transparent credit and manage their money seamlessly from a smartphone. And the response to that, because they're doing something so useful, has been incredible. Since Positive Change first invested, and that was back at their IPO in 2021, it's grown from about 40 million customers up to nearly 120 million customers today. And it keeps growing. It's adding roughly 1 million new users every month as it expands into other Latin American countries, such as Mexico and Colombia. And it's also a good reminder that financial inclusion isn't philanthropy. As Nubank has scaled, it's been a very profitable business. It's impactful and scalable. And since we invested, the share price has increased by over 300%. So again, it's a great example of where profit and purpose can go hand in hand. Now, before we move to questions, I just kind of wanted to finish with some concluding thoughts, hopefully wrapping up everything that we've covered during our session so far. Essentially, if you only read the headlines, I think you would have quite a gloomy picture. You know, flows into sustainable funds are down, policy is messy, geopolitics is tense, clean energy is volatile, healthcare has lagged, and your conclusion may be that greed is good, sin is back, and why bother? But over the longer term, we hold a really different view. I think what truly matters in systems is that lift in living standards, that societies grow when they turn discovery into broad application. And we've seen that again and again in the past. What we also see from the past is what we need is openness to change so that new ideas don't die at the gate. We need institutions and incentives that reward that experimentation. We need diffusion, education standards, networks, so that knowledge spreads. And we need patience, because compounding only works over time. And in terms of investing in those companies, and I've mentioned a few today, but happy to talk about lots more, we have to think about the enablers, those kind of hidden engines of transformation. We have to be discerning about the opportunities that we're seeking. We have to invest in businesses with durable competitive advantages that kind of survive through cycles. And we also want to hold with discipline. We want to be long-term and patient, but we also want to be demanding of the companies in which we invest. Because progress doesn't just need good ideas, it needs investment to scale them. So that's why in Positive Change, we'll be continuing to focus on finding those exceptional companies that are solving global challenges, that are turning discovery into application, and are really driving that kind of shared and sustained prosperity. Really happy to take any questions, so pop them into the chat and our discussion can continue.
Great, thank you very much for that, Rosie, for taking us through that. And yeah, we do have some time for questions if you want to put them in the box, as Rosie said. We do have a sort of question observation here. It follows on from what you were saying about perceptions of support for sustainable investing, and it's a bit of a reflection on the big issues this year. A US led by Trump seems to be in diametric opposition to a clean and sustainable future. But what are your reflections on this? We're a few months away from Liberation Day, but we've definitely seen we've seen some of the policies put in, and a little bit about what Trump may continue to do for the rest of the term. But yeah, how are you reflecting on those changes?
Yes, and it's a very fair reflection, because there's certainly it's generated a huge amount of noise. It goes without saying. Some of the policy developments, not just in terms of renewable energy, but also in areas such as healthcare, for example, the cuts that we've seen there to research and development and to the FDA are unhelpful. I think probably the simplistic way of how we're viewing them is that they're speed bumps in the road, but they're not derailing the journey. Because when you think about what's really required by the world over the coming decades, the world, if you take first of all the kind of energy transition, the world needs abundant and affordable energy. Fossil fuels cannot deliver that. You absolutely need renewable energy, which has come down the cost curve so dramatically to fulfill part of that role. So, US policy can create a bit of a speed bump, but it doesn't derail the direction of travel, because the momentum in terms of the direction we're traveling in is there. And we can see the kind of economic rationale for that, as well as the environmental rationale that holds true. So we continue to look for opportunities within the energy transition. Really similar story there with healthcare as well. So thinking long term about global demographics, two things are true. One is that we have more people in the world than ever before. World's population is now over 8 billion. Secondly, in terms of demographics, the world's population is aging, which leads to that rise in non-communicable diseases like diabetes, heart disease, cancer. And of course, the rise in those diseases, as well as being tremendously impactful from an individual patient and their family's perspective, is very impactful on healthcare systems. We need to have companies that are innovating to solve those challenges around aging and disease. And so there continues to be huge opportunity there, not only to address challenges, but to generate attractive investment returns. And we strongly believe that you can do both, that that kind of whole thesis is complementary.
Thank you for that. I wanted to ask you a little bit, a few questions about the fund and sort of changes this year. Obviously, it's been the year when SDRs come in and the different labels. And I believe you have adopted the sustainability impact label on this fund. So I wanted to ask, did that mean any changes for the fund in terms of how you're invested, reporting? Yeah, what was kind of the impact of getting that label and going through that process?
Yes. So quite an arduous process to adopt the label, which we did. It was almost exactly a year ago now that we adopted the sustainability impact label. It has meant no changes at all to philosophy or process or our portfolio, but two areas where you will see changes. One, in terms of the disclosure. So the length of disclosure within our prospectus has expanded significantly in terms of explaining exactly what we're trying to achieve, particularly on the impact side. And the second part, which we really welcome actually, is more evidencing of our investor contribution, which is really kind of shining a light on what difference are we making in terms of being shareholders of the companies in which we invest. Now, we're listed equity investors, so our financial contribution is limited. We sometimes participate in IPOs, for example, new bank, which I just talked about, or secondary capital raisings. But the primary investor contribution that we make is through engagement. So in terms of speaking to management teams, speaking to boards, as well as challenging those management teams on boards on areas that we would perhaps like to see improvement on, I think where we can add real value in terms of our investor contribution is supporting those management teams in really kind of maximizing their impact, thinking where could these management teams, in terms of the strategic direction of their businesses, really think about increasing their positive impact. I'll give you an example, just looking at Nubank, for example. That is a company we've done a lot of work on in terms of the effects of financial inclusion. I talked during the presentation about the number of people that have been included as a result of activities of companies, not just like Nubank, but others as well. But we've done quite a lot of qualitative work with Nubank on saying, so 10% of your customers have had access to a bank account for the first time, but what difference has it made to their financial security? Has it improved their financial well-being, or has it perhaps encouraged them to become over-indebted? And work like that is really interesting and actually encouraging and supporting companies to think about the kind of the consequences of their products and how they can really kind of maximize that product impact.
Great. Maybe you could talk a little bit about any changes on the portfolio this year. So new ideas that you may have included.
Yeah, really happy to do that, because we've had a big focus on idea generation, and we've been super excited that we're seeing so many ideas in different parts of the market. The common thread between all these ideas is that they are solving a particular challenge and have that ability to generate long-term returns. So, for example, within the area of environment and resource needs, we've taken holdings in ARM, which I mentioned earlier, Prismium, which is the Italian cable manufacturer, and also Savers Value Village. If anybody on the call has come across them on a visit to North America, they are North America's largest chain of thrift stores. So enables people to buy secondhand clothing and equipment, basically in a kind of TK Maxx type setting, a kind of warehouse type setting. We really like it in terms of that environmental credentials of encouraging recycling and reuse of clothes, but also in terms of the investment credentials. What they've done is so innovative in terms of their ability to effectively manage a huge and very diverse inventory. It's actually very difficult for anybody else to replicate. Switching from environment to healthcare, we've taken holdings in innovative companies such as Procept Biorobotics, which does robotic surgery for enlarged prostates. Again, kind of thinking about the kind of demographic shifts we're seeing and the need to have effective surgery in that area. We've also taken a holding in Sandoz, which is a Swiss company that produces generic drugs. Now, you may be thinking that generic drugs don't sound very exciting from an investment point of view, but we're really excited about the prospects for Sandoz. Of course, it's when drugs come off patent that they become more affordable and accessible. And Sandoz has the quite sophisticated ability to manufacture complex biologic drugs. So as we start to see those coming off patent over the coming years, there is a huge opportunity for Sandoz to make a difference there. they are also doing a lot of work in the area of antibiotic resistance, which is been named by the World Health Organization as one of the big challenges that we're facing in terms of healthcare as we become more resistant to antibiotics. So if Sandoz is able to provide solutions there, that becomes exciting from both an impact and investment return perspective. Perhaps just to finish off, because I wonder if this might be something kind of close to your heart, is we've also taken a holding in New York Times, recognizing the importance of high quality journalism in a world where in a world where we're surrounded by news flow, but where finding that high quality fact-based journalism is becoming increasingly hard. New York Times is remaining absolutely true to ensuring that news is fact-checked. They still invest a huge amount in quality journalism, in ensuring that they are doing those longer investigative journalism pieces, which are so important, not just for all of our information, but also to hold individuals and institutions to account. So recognizing that real importance of high quality journalism and the investment potential that offers through their ability to both internationalize their content, but also monetize their digital content. So two growth strands there, but a really interesting core impact case.
Yeah, definitely. I want to ask you as well about you've got around 30% of the fund in emerging markets. Is that a sort of deliberate overweight? And how have you seen that part of the portfolio developing?
Yes, yes, we've had, since we started Positive Change, we have had an overweight to emerging markets. That has been not a result of taking a top-down view and deciding that we wanted that amount in emerging markets, but rather an outcome of where we've found interesting ideas. So, for example, when we're thinking about financial inclusion, it's led us to companies such as, well, Nubank in Brazil, but also C and Grab in Southeast Asia, Kaspi in Kazakhstan. And thinking about those challenges that the world's facing often leads us to idea generation in emerging markets. So yes, there's no imperative to stay overweight, but it's certainly something that's been a feature of the portfolio since inception.
Yeah. Maybe you could talk to us a bit about performance on the fund, especially this year. Obviously, it's since Liberation Day, we've seen markets come back, and it's been led again by the tech giants. But yeah, tell us about performance and what you're seeing going into next year.
So no crystal ball. So we always think kind of almost with this with long-term investment, it's almost easier to think about those long-term structural growth trends than predict what is going to happen over the next 6 to 12 months. What we do know over the long term is that it's companies that have higher rates of earnings growth, higher rates of resiliency that will deliver strong share price performance over the long term. So when we're looking at the fundamentals of the portfolio, we see that, for example, the forward 3-year earnings predicted growth is at least 50% above that of the benchmark. So the portfolio earnings growth is predicted to grow at 17% per annum over the next 3 years. Interestingly, in terms of valuation per unit of that growth, it's looking better value than the benchmark just now. So something like the PEG ratio is sitting at about 1.3% for the portfolio compared to 1.6 for the benchmark. In terms of delivered performance thus far this year, in sterling, the fund has delivered about 10% returns. That's a few percentage points behind the benchmark kind of to the end of November. So yeah, strong fundamentals, decent performance this year, slightly behind benchmark.
And the benchmark is the MSCI World, is it?
It is the MSCI. Well, it's the MSCI Aqua, yeah.
Yeah. I'm just checking we've got any other questions. We have got a comment here a little bit about the UN Sustainable Development Goals and progress there. And I think that's something you mentioned in the presentation, as having a history there. And how do you see them fitting in? They're a good framework, aren't they? A lot of people, investors, like to see how funds are kind of linking back to those. But yeah, how do you use those within your sort of process there?
Yeah, in terms of how we use the UN Sustainable Development Goals, for every single company within the portfolio, we map how their products and services are contributing to the Sustainable Development Goals, and we do that at underlying target level. So underlying the 17 Sustainable Development Goals are 169 very specific targets. So we're able to map the portfolio holdings against those targets. And then we report on progress against those targets in our annual impact report. So that's how we kind of incorporate it at a portfolio level, and investors are able to see that within our annual impact report. We obviously keep an eye on progress of the Sustainable Development Goals more broadly, and the UN publishes really useful reporting on that. So, their most recent report will take the kind of 17 Sustainable Development Goals and effectively RAG rate progress against them, whether are there aspects of the goals that are absolutely on target to be met, ones that are in progress, or ones that have stalled or going backwards. And as you would expect, it's a real patchwork in terms of areas where really striking progress has been made and others which have really stalled.
Yeah. And just finally, let's look again a little bit into next year. What are some of the key areas and discussion points you're having with your team? I mean, obviously a big topic at our recent conferences has been about AI, and is it in a bubble? And if so, what do we do about it? But also around concentration risk in the US. These are kind of broader investment issues, aren't they? But maybe you could touch on some of your kind of discussions around those, and then I suppose any specific sustainability issues as well that you're bringing into that.
Yeah, I think it is really interesting. Obviously, there is lots of talk in the market just now about the kind of high levels of concentration that we're seeing within the index, the relatively high levels of valuation of some of those AI companies. I think within Positive Change, we're benchmark agnostic. So we're not compelled to own any proportion of the benchmark, or indeed we can go off benchmark in terms of selecting companies for the portfolio. What we really want to do is stick to constructing a portfolio that absolutely meets our philosophy over the next 5 years. So we're looking for companies that have that ability to double in share price terms and contribute towards a more sustainable world. Now, of course, macroeconomic factors play into that too, because if you're looking at the valuation of individual companies, you want to ensure that you're investing in companies with sensible valuations. We also want to invest in companies, given that the world is a very sort of unpredictable, uncertain place, companies that are run by adaptable and agile management teams, companies that are being sensible in terms of their capital allocation, that have resiliency in terms of their balance sheets, and are showing an ability to manage a world where interest rates and inflation are somewhat unpredictable. Are these companies that have the ability, for example, to exercise pricing power? So we are fundamental bottom-up stock pickers, but of course that kind of macro has to play into the prospects for the individual companies in the portfolio. And then maybe finally, just on portfolio construction, we invest in 35 companies that we're really excited about. But despite running a concentrated portfolio, we want to ensure that it's a diverse portfolio, not just in terms of geography or sector, but also in terms of the types of growth businesses we're investing in, so that we have a mix of companies that offer sort of steady compounding growth, companies that offer very kind of rapid growth, and also companies that are a mix of maturities, because it's through that diversification that we ultimately think will achieve both of our objectives. So, the world is an infinitely fascinating place. And we just want to make sure that we're investing in a range of exceptional and diverse businesses that can capitalise on that.
And for some people listening today, they may have been with us throughout the year when we've been joined by different managers from Baillie Gifford running different strategies there. How does this fit into the suite of funds? What's the overlap with other funds? How could they expect similarities and differences with this portfolio? Obviously, with the twin objectives that you have there.
Yeah. So in terms of similarities, what we all have in common across Baillie Gifford is that long-term active growth, fundamental bottom-up stock picking. So at heart, we share that characteristic. Of course, within positive change, what we're also looking for, as well as those kind of growth businesses, are companies that are going to achieve that growth through their products that are solving societal challenges. In terms of what that means in terms of actual overlap, about 90%, so that would be 90%, of positive change companies are held somewhere else at Baillie Gifford. It might be a global portfolio, it might be a regional portfolio. The highest single amount of overlap is probably with our long-term global growth portfolio, and that is about 24% as at end of September. So yes, we share a kind of a common core, but a unique philosophy.
Yeah. Great. Well, thank you so much for joining us today, Rosie, and taking us through that and answering our questions. As you said, a lot to talk about, a lot happening, but some really interesting insights from your team's perspective there. So before we wrap up, let's just go through those learning objectives again for the session, which were to explore the changing backdrop for sustainable and impact funds, understand how solving global challenges are already providing some of the great structural growth opportunities of the coming decade, and consider how technology has the potential to supercharge positive progress. I'd like to thank Rosie again for joining us and taking those questions. If you do have any extra questions and you'd like to put them to the team, I'm sure Rosie and Baillie Gifford will do their best to answer them after the event. And just a reminder that CPD will be delivered tomorrow. And just before I go, I'd like to show you a bit of a teaser of PA events as we race towards 2026. Can't believe we're nearly at the end of the year already. Next Thursday, the 11th of December, we're closing this year's calendar. We've got our final working lunch of the year. That's with Schroders, and they're going to present the results of their annual advisor survey. So we'll be joined by Schroders' Stuart Podmore and Jamie Fowler, and their guest will be Philip Martin, who's CEO of Unique Financial Planning, to give the advisor view. So that's always a popular session, so don't miss it. After the Christmas break, back on the 15th of January, we'll have our online Scotland Investment Masterclass featuring Copia Capital, Downing, L&G, Orbis, Schroders and Tatton. If you're listening to this event in Scotland, please look out for your invitation in your inbox. And we're back on the road again in the final week of January. That's for our annual Q1 multi-asset and MPS roadshow. So on the 27th, we'll be at Rudding Park in Harrogate, 28th in Warrington, and the 29th, we're back to the National Conference Centre in Birmingham. And then the next week, we'll be at Lee Court in Bristol on the 4th of February and finishing as ever at 1 Whitehall Place in London on the 5th. And our presenters there will be Aberdeen Advisor, BlackRock, HSBC Asset Management, Morningstar Wealth, Orbis and Quilter. So that's a total of 10 hours of CPD over the next couple of months. And as ever, if you wish to find out information, sign up to any of our events or become a free member of Professional Advisor, then please do so and visit professionaladvisor.com/events. That's it for me for today's session. Thanks again to Rosie for joining us and taking us through those questions there. And thank you very much for your company this lunchtime. Hope you found the session helpful and worthwhile. And we hope to see you at another PA event very soon.